Michael Burry is famous for predicting the '07 housing bubble and the Great Recession which followed. That prediction was worth $800 million to Burry and his investors, and was so iconic that a movie called The Big Short was made about it. Burry has a knack for calling catastrophic economic events before they happen, and his latest warning about the stock market has investors worried that a cataclysmic crash is coming. On Twitter, talking about the stock market, Burry said the silliness is back. After 1929, 68, 2000 and after '08, the strain of silliness that transformed bulls into bubbles completely and utterly disappeared. But that familiar COVID era silliness is not dead yet, like '01 before Enron, before 9/11, before WorldCom. Before we break down what Burry is talking about in this tweet, leave a comment below with your thoughts on the current state of the stock market and whether or not you're currently investing. Alright, so the silliness that Burry is talking about is referring to the recent rebound of the stock market. In June this year, the S&P 500 was officially declared to be in a bear market. That's because the price of the index had fallen by more than 20% beneath its last high point, which was in January this year. But it's not just the S&P 500 which has performed poorly. In June, the Nasdaq was down by over 30% since its last high, and in the world of cryptocurrencies, Bitcoin had fallen by nearly 70% since its peak. There were many contributory factors to this poor performance, including inflation, rising interest rates, and the global supply chain crisis. But the market has since reversed what has been the worst first half performance since 1970. Since June, the S&P 500 is up by over 12%, while the Nasdaq and Bitcoin are up by 17% and 25% respectively. Michael Burry does not think that this rebound is sensible and has described it as investor silliness. Burry believes that the investor behaviors which fueled the unprecedented rally in global stocks between March 2020 and the end of 2021 are once again showing their faces. This is the kind of behavior which saw investors throw billions into SPACs, meme stocks, NFTs, cryptocurrencies, pretty much anything that was trending online that could be used to make a quick dollar. Back then, this was all made possible through rock bottom interest rates, money printing and stimulus checks. We are now of course in a very different economic climate, and the question is whether Burry is being overly pessimistic about the rebound or whether he's spot on, and this is all just irrational exuberance to quote Alan Greenspan. What's most likely is that the rebound in prices which we're seeing is a bear market rally. A bear market rally is defined as a sharp, short-term rebound in share prices amid a longer-term bear market decline, and is sometimes referred to as a dead cat bounce or bull trap. During the aftermath of the dot-com bubble in the stock market, the Nasdaq had 9 price rallies in excess of 10% between 2000 and 2003. If you were to look at these periods in isolation, you might think that the stock market was rebounding, but when you zoom out and look at the longer-term performance, you realize that these rebounds were just brief interludes in the stock market decline. If this is a bear market rally, then 3 questions come to mind. Why was the stock market declining prior to the rally? Why is the market rallying now? And why do we believe that the market will continue to decline after the rally has finished? The stock market has been under a lot of pressure this year, and as for the reason why, that can be summarized with one word: inflation. Inflation has been the #1 most consistent financial headline not only in the US but pretty much everywhere globally for many months now. You see, in response to the pandemic, both the US Federal Reserve and the European Central Bank, among others, rolled out extremely supportive monetary policies. They kept interest rates at record lows while also committing trillions of dollars and euros to purchasing programs centered around buying up government bonds and mortgage-backed securities. The goal of all of this was to keep the economy from collapsing. They were trying to encourage as much spending as possible by making the money supply very cheap and accessible. This led not only to an explosive increase in the valuations of stocks, property and cryptocurrencies as money flooded the markets, but also to a significant increase in demand for goods by consumers. The problem was that our global supply chains were reeling from the effects of the pandemic and therefore couldn't provide the supply to match demand. This led to too many dollars chasing too few goods, which is the reason why we initially started to see inflation rates rising. This problem was compounded, particularly in Europe, by the Russian invasion of Ukraine. That sparked an energy price crisis which has only served to exacerbate the situation. All of these factors set the scene for what would become the worst first half stock market performance in 50 years. But they weren't the cause of the crash. The cause was the response of the US Federal Reserve. The responsibility for ensuring that prices remain stable within the economy lies with global central banks. They have an inflation rate target of 2%, which is obviously far below where inflation is currently at. Naturally, they had to respond to the cost of living crisis, which was quickly spiraling out of control. That response came in the form of interest rate increases. The Fed has increased rates from virtually 0% in February this year to a target rate of between 2.25 and 2.5% today. The purpose of these rate increases is to try and slow consumer demand, because rising rates makes borrowing money more expensive, which in turn restricts money supply, lowers demand, and curbs inflation. But rising rates also impact stock prices, which is partly why we've ended up in the bear market that we find ourselves in today. The price of every stock on the stock market represents the market's expectations for future company cash flows, discounted back to the present day. The present day value of those future cash flows is calculated using what's known as a discount rate, and the discount rate is influenced by interest rates set by global central banks. The higher interest rates go, the more heavily future company cash flows are discounted. This leads to a decline in stock prices. Growth stocks are disproportionately impacted by this, simply because so much of the value of growth stocks is predicated on future company cash flows. That's why many NASDAQ listed stocks are among the worst performers of 2022, given that most growth stocks tend to be listed on the NASDAQ. But rising rates don't just impact stock prices from a valuation perspective. There's also a very tangible effect that rising rates have on the financial performance of the companies which underpin any given stock on the stock market. You see, rising rates hurt corporate earnings. As mentioned previously, when interest rates rise, it becomes more expensive to borrow money. For many companies, that means existing loans become more expensive to repay, as do any new loans which the company may wish to take out. This hurts stock prices in two ways. Number one, higher repayments lower earnings per share, which subsequently lowers stock prices. And number two, more expensive loans limit how much a company can borrow to fuel its growth. This will almost certainly reduce the market's expectations for future company cash flows, again hurting stock prices. That's before we consider that consumer demand will naturally be lower given that rates are rising, meaning that companies will be selling less and generating less revenue. So this is why the stock market has been in a state of decline for much of 2022. But what changed to spark the rally which we've seen as of late? Honestly, not much. US gross domestic product, or GDP, fell for the second consecutive quarter in 2022, which under historical definitions would technically put the US economy in a recession. Fed officials have said that while the US economy has contracted as a whole, it's not showing the typical characteristics of a recession. For example, in a recessionary climate, we would expect to see higher levels of unemployment, and that's because businesses are struggling with lower consumer demand and higher costs. But the US labor market actually added 528,000 jobs in July, showing one of the strongest labor markets in history. So that could be a reason why investors are optimistic. The other factor to consider is that because the US economy has contracted for 2 consecutive quarters, investors could be expecting the Federal Reserve to ease up on their interest rate hikes, which would obviously be a positive outcome for stock prices. But I don't think that's going to happen, and that brings me to our final question. Why do the likes of Michael Burry believe that the market will continue to decline after this bear market rally has concluded? Why is it that Burry sees the rally as investor silliness? First off, inflation will very likely continue to persist. The Federal Reserve has reiterated time and time again that they will continue to increase rates until they're satisfied that inflation is declining at their desired rate. Up until now, the rate hikes have done very little to slow inflation, with the latest data from July showing a slight improvement, but in my opinion, nothing to get excited over. And even if the Federal Reserve can slow consumer demand, they have no control over the supply side of the equation. If supply chain constraints continue to persist, so too will supply shortages, which will impact prices. Thankfully, data from the Global Supply Chain Pressure Index shows a 57% decline since its high point in December 2021. So the road to recovery is very much underway, but that doesn't mean that inflation will subside significantly anytime soon. We don't know for certain how far the Federal Reserve will go with rate increases, but we do know that there's more in store for the future. And because of that, the fear of a true recession continues to loom, one marked by lower revenues, higher costs, and higher unemployment. And if that's going to be the case, then it certainly is silly for the market to be in any sort of rebound, because nothing has changed. No new information has come to light to suggest that we're on the up and up. Plus, as rates continue to increase, future company cash flows will continue to be discounted heavily, resulting in continued stock price declines. Then we have to consider the consumer. Burry has made some predictions about US consumers for the latter half of 2022. He expects consumers to have exhausted their savings as a result of the cost of living crisis which we're currently seeing. This will lead to weaker consumer spending, higher debt, and lower corporate earnings. A recent survey found that 85% of US consumers are concerned about rising inflation, and over half have seen a notable decline in their standard of living. 71% have already started to cut back on their spending, so it's not hard to see why Burry is expecting a weaker consumer by Q4 2022. But this also has the potential to help tame inflation, given that inventories of certain items among retailers shares will remain bloated as consumer demand weakens, resulting in price declines. Walmart, for example, is reportedly eliminating 200 corporate jobs on the back of lower profit forecasts, with rising costs, mounting inventory, and lower consumer demand already taking its toll. Finally, we have to consider the current state of the market itself. In January this year, Jeremy Grantham, who is the co-founder of the investment management firm GMO, said that the US was in what he called a super bubble, and it was only the fourth such bubble in the last 100 years. Grantham shares a lot of the same views as Burry, and his rationale for the so-called super bubble sounded eerily similar to Burry's outlook. Grantham pointed out that post-March 2020, stock prices accelerated much too quickly, and in previous super bubbles, the same rapid price acceleration was also seen. Since then, the S&P 500 has entered a bear market, and even with the price decline, the likes of Credit Suisse see stock prices declining even further if this bear market is to be in line with historical patterns. Grantham also pointed to the price collapse of speculative investment managers like Cathie Wood and ARK Invest, and he also referenced the crazy behavior of investors since 2020, similar to Burry's comments about investor silliness. At the time Grantham published these comments, the S&P 500 was down about 6% from its high, and by June that was over 20%. But he predicted that the index will collapse by around 40%, and if that turns out to be true, not only do we have much more red days ahead, but it would also certainly be fair to describe any current price increases as investor silliness. So where do we go from here? In reality, nobody knows for certain where the stock market is going to go today, tomorrow, next month, or next year. Michael Burry and Jeremy Grantham are just speculating on the future of the market. That doesn't mean things are guaranteed to work out that way, and to the same extent that they predict. Elon Musk has called Burry a broken clock in the past, particularly in response to his comments on Tesla. And while I don't necessarily back Tesla as an investment, it is fair to say that many of these doom and gloom commentators are, more often than not, inaccurate with their predictions. What people fail to realize is that recessions, booms, bear markets, and bull markets are all natural ebb and flows in the grand calculus of the financial system, and it's very likely that in our lifetimes we'll see many of them. There is no one who can accurately predict the nature, timing, and extent of every crash in the stock market. It's simply not possible. But there is a learning point from that, and it's the importance of long-term investing. Provided you have decades to go until retirement, you shouldn't care about what happens in the market in the short term. And the way to not care about what happens in the market is to make sensible, low-cost, and diversified investments, and to do so consistently for decades, irrespective as to what's happening now. You're buying on the way up, you're buying on the way down. And the reason why is because you understand the power of compound interest, and you understand the importance of starting early and staying consistent. All of these news headlines and predictions only serve to derail you from your path. So while I do encourage you to stay up to date with what's going on and to understand why people are saying what they're saying, I would also encourage you to think for yourself and to make financial decisions which make sense in the context of your own personal circumstances as an individual. But I want to hear from you. What are your thoughts on Burry's comments and the current state of the stock market? Are you investing at the moment, and have you made any changes to your investment strategy? Let me know in the comments. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.